Today, on our review for the Securities Industry Essentials exam, we are diving into the world of alternative investments. This category includes investments that fall outside of traditional asset classes like stocks, bonds, and cash. These are generally intended for sophisticated investors who have a high risk tolerance and a significant net worth. First, let's talk about hedge funds. These are private investment partnerships that are open to a limited number of investors. The exam will expect you to know that they use a wide variety of aggressive and complex strategies. For instance, a hedge fund might engage in short selling, use derivatives like options and futures, and employ a great deal of leverage, which means borrowing money to amplify potential returns. A classic example is a long-short equity fund, which takes long positions in stocks it expects to appreciate and short positions in stocks it expects to decline. You must also remember their common fee structure known as 2 and 20, which consists of a 2% management fee on assets and a 20% fee on any profits earned. Next up is private equity. While often grouped with hedge funds, private equity funds have a different focus. Instead of trading securities, they specialize in buying and managing entire companies. They might acquire a struggling public company and take it private to restructure it, or they might invest in a promising startup before it goes public. The key difference to remember for the test is the time horizon. Private equity is a long-term, hands-on investment, often holding a company for 5 to 10 years before seeking an exit through a sale or an initial public offering. Then we have structured products. These are pre-packaged investments that are financially engineered to have specific risk-return characteristics. A common example you might see is an exchange-traded note, or ETN. An ETN is an unsecured debt security that tracks an underlying index of securities. While it sounds like an ETF, the critical difference and a frequent exam trap is that an ETN's value is also tied to the creditworthiness of the financial institution that issues it. If that institution goes bankrupt, the ETN could become worthless, regardless of how the underlying index performs. This introduces credit risk, which is not present in the same way with an ETF. The gateway to these investments is the accredited investor requirement. The SEC sets specific financial thresholds to ensure investors are sophisticated enough to understand and bear the risks. For an individual, this means having an annual income of over $200,000, or $300,000 with a spouse, for the last 2 years, with the expectation of the same in the current year. Alternatively, an individual must have a net worth of over $1 million, excluding the value of their primary residence. The exam loves to test these specific numbers, so they are crucial to memorize. Finally, the most significant risk associated with all these investments is their lack of liquidity. You cannot simply sell your stake in a hedge fund or private equity fund on an open market. Hedge funds often impose lock-up periods, preventing you from withdrawing your money for a year or more. Private equity is even more illiquid, as your capital is tied up for the life of the fund. To help you remember the key traits of alternative investments for the exam, think of them as being for the RICH investor. They are restricted to accredited investors, highly illiquid, complex in their strategies, and intended for high net worth individuals who can afford the potential losses.